Did you know that a single decision by the Federal Reserve can make your mortgage more expensive, your investments less profitable, and even determine whether businesses expand or go bankrupt? Interest rates are the silent force shaping our financial lives, and understanding them is the key to making smarter money moves. Imagine two people, Marcus and Sophia. Marcus took out a loan when interest rates were low, locking in a manageable monthly payment. Sophia, on the other hand, waited a year, and by then, rates had jumped. Now she's paying hundreds more per month for the same loan. What happened? And how can you make sure you're on the winning side of interest rate changes? Let's break it down. Interest rates affect two major areas, borrowing and investing. When rates rise, borrowing becomes more expensive, whether it's for a mortgage, a car loan, or business expansion. Think about it. A 1% increase in mortgage rates can add tens of thousands of dollars in interest over the life of a loan. That's why homeowners rush to lock in low rates before they climb. But what about investors? Higher interest rates often mean stocks take a hit. Why? Because as borrowing costs rise, businesses cut back on growth, which can lower stock prices. Plus, investors start shifting money into safer assets like bonds, which become more attractive when rates climb. On the flip side, when interest rates drop, borrowing gets cheaper, the stock market tends to rally, and economic growth accelerates. Let's put this into real numbers. According to the Federal Reserve, the average interest rate on a 30-year mortgage in 2021 was around 3%. Fast forward to 2023, and that rate shot past 7%. That means a $400,000 mortgage would cost you nearly $1,000 more per month in interest payments alone. That's why timing matters. So what's the strategy? If you're borrowing, pay attention to the economic cycle. Lock in low rates when they're available. If you're investing, diversify, because different assets respond differently to interest rate changes. And if you're holding cash, remember that higher rates mean better returns on savings accounts and bonds. But here's the real takeaway. Interest rates aren't just numbers on a screen. They're signals, indicators of where the economy is heading. If you know how to read them, you can make smarter financial moves, avoid costly mistakes, and even turn economic shifts to your advantage. Want to stay ahead of the curve? Keep learning, keep planning, and most importantly, stay informed. And if you found this valuable, you're going to love what's coming next. Click on the video on your screen and take your financial knowledge to the next level.